Hi everyone, my name is Shambhavi Joshi, and I am going to be talking about the Great Depression and the New Deal, and how this all relates to a more recent economic crisis the US has faced. The Great Depression was a financial crisis that began in 1929. But to really understand why the economy failed, we need to understand the causes of the Great Depression. One of the many causes was the uneven distribution of wealth. There was a huge wealth gap between the top 5% and the bottom 95% of the population, and a lot of people couldn't afford basic items. However, due to the rise of consumerism during the 1920s, people still managed to buy expensive items with the use of credit. In fact, the overuse of credit. Essentially, people began buying goods they could never afford. They borrowed more money than they could pay back. And we're going to see how this is a problem when there's the run on the banks and the stock market crashes. The next problem was the overproduction of businesses. Due to businesses booming in the 1920s, more and more workers were being hired, and they produced too much of a supply. When there's a supply and demand imbalance, this can cause major problems in the economy. When supply exceeds demand, a phenomenon called deflation occurs because prices drop and the value of the dollar increases, decreasing economic activity. Once the stock market crashes, however, there's even less economic activity and no money in circulation, which is only going to worsen the depression. So what was the stock market crash and why did it happen? The stock market crash happened due to a bull market, which is when stock prices rise. But they weren't rising because businesses were growing. They were rising due to speculation. Speculation is when people think the stock market is going to continue to rise, so they put more and more money into the stock market. But actually, businesses weren't growing, and stock prices didn't reflect the true value of the company. In fact, in 1929, 10% of American households owned stocks, but not all of them could afford stocks, so people bought stocks on margin, kind of like credit. Buying stocks on margin was when stockbrokers loaned money to people to buy stocks. Stockbrokers would get this money from taking loans out of a bank. During this time period, the Federal Reserve kept interest rates really low, so banks were encouraged to make very risky loans. Banks would loan money to stockbrokers at very low interest rates, and stockbrokers would loan this same money to people to buy stocks at much higher interest rates, making profit for these stockbrokers. Many people didn't mind the high interest on these stock margins because they expected to get high returns from the stock market due to increasing prices. But at any time, a stockbroker could call a margin call, and you would have to pay back all the money you owed them. The only way for people to pay back the stockbroker was to sell their stocks. But when the stock market crashed, they couldn't sell their stocks for the correct amount of money because stock prices were dropping drastically. So stockbrokers weren't getting the money back that they had loaned, and banks weren't getting the money that they loaned to the stockbrokers back. Now the bank doesn't have any money, and when millions of people ran to the banks to get their money and life savings, the banks didn't have it. This was the run on banks. Everyone decided to pull out their life savings at the same time, but the banks did not have that type of money on reserve. In 1932, when the country was deep in the Depression, Franklin D. Roosevelt won the election for president, and he promised the country a New Deal. From that point onward, Roosevelt's policies for ending the Depression and restoring prosperity to Americans was called the New Deal. He started off with the first New Deal, and the first thing he did was declare a bank holiday on March 6th of 1933. It lasted 4 days, in which banking transactions were suspended across the nation. In this time, he created the Emergency Banking Relief Act, which determined if banks were fit to reopen or if banks were unfit to continue business. The following acts were very impactful, some being major successes and some not so much. Some notable first New Deal acts include the Securities Act of 1933, which enforced the Securities and Exchange Commission, which still exists today. It was created to regulate the stock market and stop fraud. It inspects stockbrokers, investment advisors, and agencies that rate stocks. However, some of these acts did not succeed, such as the Agricultural Adjustment Act. It paid farmers not to raise certain livestock due to the farmer crisis. It told them not to grow certain crops and produce dairy products. This caused an increase in food prices, which drew criticism because not all people could afford this food during the Great Depression. In fact, many thousands of tenant farmers lost their jobs and homes because of this. Another successful act includes the Federal Deposit Insurance Corporation. It was also called the Glass-Steagall Act. It separated commercial banking from investment banking, and it restored faith in banks. The Second New Deal also had many notable impacts. For example, the Work Process Administration put roughly 8.5 million Americans back to work, which was a major success. Another example is the Social Security Act, which was passed in 1935 and still is present today. It contributed funds for children, the blind, unemployed, family health services, and vocational training programs. Some of these acts were not successful, however. The Judicial Procedures Reform Bill, or the Court Packing Bill, was declared unconstitutional. FDR feared that the Supreme Court would go after Social Security, so he proposed this bill to increase the number of Supreme Court justices to allow him to appoint justices who would support the New Deal, which was a political mistake because in the end it was determined unconstitutional. So as you can clearly see, this is a lot of legislation, but did it really do anything? Pros of the New Deal included the fact that after the first New Deal was launched, the economy grew 10.8%. And when the second New Deal rolled out, the economy increased by 8.9% in 1935, and then another 12.9% in 1936. From 1932 to the year before the New Deal to 1941, when the US entered World War II, the debt only grew by $3 billion, which is not that much. Recessions are less severe today because of the new federal agencies that control corruption, fraud, and exploitation, such as the SEC. Cons of these policies included that not all of them were successful. In fact, some people say the New Deal didn't work at all because the Depression lasted for 10 years. Others argue that FDR spent 30 times more in 1943 on World War II than he did in 1933 on the New Deal. They say that if FDR had spent as much on the New Deal in 1933 as he did in the war in 1943, it would have ended the Depression by creating jobs, demand, and economic growth. The Depression's misery helped propel the German people to put the Nazis and Hitler in power. If FDR and the New Deal had ended the Depression in early 1930s, the United States could have turned its resources sooner to helping its allies, Great Britain and France. It might have at least shortened, if not prevented, World War II. Lastly, people say that it set a precedent for excess government involvement in the economy. Now let's discuss another economic crisis that occurred from 2007 to 2009. It was called the Great Recession. This is a term that represents the sharp decline in economic activity during this time period. It's considered the most significant downturn since the Great Depression. The statistics show that the national unemployment rate rose from 5% in December of 2007 to 10% in October of 2009. Gross domestic product declined by 4.3% from 2007 to 2009. 3 million households were foreclosed during this time period, and mass layoffs, which occur when 50 or more claims for unemployment insurance are filed, involved 326,392 workers in just February of 2009. Overall, the Dow Jones Industrial Average declined by 50% in 2007, and the Dow Jones Index plummeted more in the following years to a low of under 10K for the first time ever. Even the S&P 500 declined by 57.8%. Just as we did with the Great Depression, it is important to understand the causes of the Great Recession from 2007 to 2009. So in the wake of the 2001 recession and the World Trade Center attacks of 9/11, the U.S. Federal Reserve pushed interest rates to the lowest levels in an attempt to maintain economic stability. This, combined with new financial innovations such as new types of subprime mortgages and adjustable mortgages, allowed borrowers who otherwise might not have qualified to have mortgages. Before understanding why the house market was growing and the housing bubble in general, it's important to understand mortgages and how they work. Essentially, when you borrow money from a bank to buy a house, they hold a mortgage paper. And if you can't pay back your mortgage rates on time, there's a default and they just take your whole house or whatever you own. Now, generally, it's harder to get a good mortgage or just a mortgage in general with bad credit. So during this time, banks started selling mortgage papers to other investors. Now, this always used to happen, but in the 2000s, investors started throwing more and more money at the housing market, thinking they could get more money from mortgage interest rates compared to treasury bonds. Investors started purchasing mortgage-backed securities. Essentially what these were, where banks would buy thousands of mortgage papers and bundle them together, selling them to investors. And home prices were going up at this time, so it seemed like a good investment. Worst case, if there was a default, they could just sell the house for more money. More and more investors wanted to buy these mortgage-backed securities, so lenders started giving out more mortgages, or subprime mortgages. These subprime and adjustable mortgages gave mortgages to people with bad credit scores. Overall, they were very risky. Eventually, the housing bubble burst. Prices grew to a new high, and people couldn't pay for expensive houses anymore, and there were more defaults. More seriously, the rates on existing adjustable mortgages and even more crazy loans began to reset at much higher rates than many borrowers expected or were led to expect, and this caused the housing bubble to burst. Big investors lost a lot of money. The Federal Reserve steadily was increasing interest rates during this time period in an attempt to maintain a stable rate of inflation in the economy. And this caused a somewhat of a credit crisis too, and credit was used to fund a lot of these housing issues and the housing bubble. The road to recovery from this included the government lowering interest rates to nearly zero to promote liquidity. They also provided banks with $7.7 trillion of emergency loans. They enforced fiscal policy, which is essentially when the government puts a lot of money into the economy to stimulate economic growth. And in 2010, President Barack Obama signed the Dodd-Frank Act to give the government expanded regulatory power over the financial sector. According to some economists, the repeal of the Glass-Steagall Act, which I discussed earlier, that occurred during the Depression era, it caused the recession in 2007 to 2009. And this Dodd-Frank Act that President Obama signed was similar to the Glass-Steagall Act. Overall, both these events shared similar causes: low interest rates from the Federal Reserve, unwise usage of credit and loans, caused these recessions and depressions. The recovery in both these situations required fiscal policy. The government needed to start spending money to get the economy flowing again, and government involvement was needed. Acts needed to be passed, and there needed to be monetary guidelines over the financial sector. and these are my works cited. Thank you for watching my presentation.